Welcome to Money Briefing. Today we're addressing a widespread misconception that could cost you money. Many people believe that recent political promises mean Social Security benefits are no longer taxed. This is incorrect. If you receive Social Security benefits and have any additional income, you are likely still paying federal taxes on those benefits. The rules governing these taxes have not changed, and understanding how they work is essential for protecting your finances. This briefing will explain exactly who pays taxes on Social Security, why these outdated rules from the 1980s continue affecting millions of Americans, and what steps you should take during tax season to protect both your current finances and your future benefits. The taxation of Social Security benefits began in 1984, following recommendations from the Greenspan Commission. At that time, policymakers were attempting to strengthen Social Security's financial foundation for future generations. Among several changes implemented, they introduced taxation on Social Security benefits for higher-income retirees. The logic behind this taxation remains controversial. Throughout your working life, you paid FICA taxes at 6.2% of your wages, with your employer contributing an additional 6.2%. When benefits are taxed again upon receipt, many consider this double taxation on the same earnings. Regardless of opinions about fairness, these rules remain in effect today. In 1984, Congress established specific income thresholds for Social Security taxation. Single filers earning over $25,000 in combined income and married couples earning over $32,000 would face taxes on their benefits. At that time, these amounts represented substantial retirement income, meaning this tax was designed to affect only wealthy retirees. Here is where the situation becomes problematic. Those thresholds established in 1984, the $25,000 for single filers and $32,000 for married couples, have never been adjusted for inflation, not once in over 40 years. These numbers remain frozen while everything else in the economy has increased dramatically. Housing costs have multiplied, grocery prices have soared, medical expenses have skyrocketed, minimum wages have increased in most jurisdictions. Yet these tax thresholds remain locked at 1984 levels. What was once a tax affecting only wealthy retirees now captures ordinary working-class Americans simply trying to maintain basic living standards. Congress has not enacted any major Social Security reform in 4 decades. This legislative inaction means the system continues operating under outdated parameters that increasingly burden regular Americans rather than the wealthy individuals originally targeted. The IRS uses a specific formula called combined income to determine whether your Social Security benefits are taxable. This calculation adds your adjusted gross income, which includes wages, IRA withdrawals, interest, and other income, plus any non-taxable interest you receive, plus exactly half of your Social Security benefits. That final component is crucial. Only 50% of your Social Security benefits count toward the threshold calculation. If you receive $30,000 annually in Social Security benefits, only $15,000 is included when determining your combined income. For single filers, combined income below $25,000 means no taxes on Social Security benefits. Combined income between $25,000 and $34,000 means up to 50% of benefits may be taxable. Combined income exceeding $34,000 means up to 85% of benefits may be taxable. For married couples filing jointly, combined income below $32,000 means no taxes on Social Security benefits. Combined income between $32,000 and $44,000 means up to 50% of benefits may be taxable. Combined income exceeding $44,000 means up to 85% of benefits may be taxable. Consider a single person receiving $24,000 annually from Social Security while working part-time and earning $10,000. Their combined income calculation would be $10,000 in wages plus half of their $24,000 Social Security benefit, which equals $12,000. The total combined income is $22,000. Since this falls below the $25,000 threshold, no Social Security benefits would be taxed. However, if that same person received a raise bringing their part-time income to $16,000, their combined income would jump to $28,000. Suddenly, up to 50% of their Social Security benefits become taxable. A modest income increase triggers significant tax consequences. Several groups face particular challenges under these rules. Working retirees attempting to supplement Social Security with part-time employment often find their extra earnings push them into taxable territory. The effort to improve their financial situation results in unexpected tax burdens. Widows and widowers face especially difficult circumstances. When a spouse dies, one Social Security check disappears while household bills remain largely unchanged. Many surviving spouses take on work to compensate, which then triggers taxes on their benefits. Americans who saved responsibly throughout their careers encounter penalties for their prudence. Money placed in 401k accounts or traditional IRAs during working years now counts as income when withdrawn, pushing retirees into higher tax brackets on their Social Security benefits. Responsible financial planning effectively results in punishment. Disabled workers attempting to work within allowed limits face similar challenges. Income earned while on Social Security disability can trigger taxation of those disability benefits. Veterans supplementing Social Security with VA benefits or part-time work also frequently find their benefits become taxable. The pattern is clear. Those working hardest to remain financially stable face the greatest tax burdens. Federal taxation represents only part of the picture. 9 states also impose their own taxes on Social Security benefits. These states are Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. Residents of these states face double taxation on their Social Security income, paying both federal and state taxes on benefits they earned through decades of work contributions. An important aspect of Social Security taxation that receives little attention involves where that tax money goes. When you pay taxes on Social Security benefits, the IRS directs those funds back into the Social Security Trust Fund. In 2024, approximately $54 billion flowed into the trust fund from taxation of benefits. This creates a complicated situation. The taxation is arguably unfair, and the thresholds desperately need updating. However, eliminating Social Security taxation entirely without replacing that revenue would remove $54 billion annually from an already struggling trust fund. Current projections indicate the trust fund will be depleted in approximately 86 months, just over 7 years. When depletion occurs, benefits face automatic cuts of at least 23% for all recipients, regardless of when they started receiving benefits. Removing the taxation revenue without replacement would accelerate this timeline and potentially increase the eventual benefit cuts. Beyond understanding current tax rules, every American should take one essential step after filing taxes each year. Visit ssa.gov and access your My Social Security account. Once logged in, review your earnings record to confirm that all FICA taxes paid from your paychecks were properly credited to your Social Security account. Errors occur more frequently than most people realize. Employers make mistakes. Social Security numbers get transposed. Earnings sometimes fail to appear in the system. Catching these mistakes early is essential because correcting them becomes increasingly difficult as time passes. Cases exist where individuals discovered earnings record errors and, after correction, saw their monthly benefits increase by $400 to $500. That represents $6,000 annually in additional benefits that would have been lost without verification. Waiting until age 62 or 67 to discover that earnings from decades earlier were not properly recorded creates serious problems. The employer may no longer exist. Documentation may be impossible to locate. Proving what you earned becomes extremely challenging. Make earnings record verification an annual habit. The process takes approximately 5 minutes and could protect thousands of dollars in future benefits. Previously, the Social Security Administration mailed annual statements showing earnings history, but budget cuts eliminated that practice. Verification is now entirely the individual's responsibility. Several approaches can help minimize the tax burden on Social Security benefits. Understanding your combined income number and where you stand relative to the thresholds is the essential first step. This knowledge enables informed decision-making about additional income sources. Roth conversions offer one strategic option. Converting traditional IRA funds to Roth accounts over time means those future withdrawals will not count as taxable income, potentially keeping combined income below threshold levels. Timing withdrawals strategically can also help. If retirement account withdrawals are not immediately necessary, delaying them may prevent crossing into higher tax brackets on Social Security benefits. Geographic considerations matter for some retirees. Those living in states that tax Social Security benefits may find that relocating provides significant annual savings, though such decisions involve many factors beyond taxes alone. Consulting with tax professionals who specialize in retirement planning can identify strategies specific to individual circumstances. Professional guidance often reveals legitimate approaches to reducing tax burdens that individuals might not discover independently. The taxation of Social Security benefits represents one symptom of a larger problem. Congress has avoided meaningful Social Security reform for over 40 years, while the system moves steadily toward insolvency. The frozen thresholds from 1984 continue pushing more middle-class Americans into taxation originally designed for the wealthy. Understanding these realities enables better planning and decision-making. The rules may be frustrating, but knowledge of how they work provides the foundation for protecting your financial interests within the existing system. Money Briefing will continue monitoring any changes to Social Security taxation rules and trust fund developments. For now, the 1984 thresholds remain in effect. Combined income calculations determine taxability, and verifying your earnings record annually represents one of the most valuable 5-minute investments you can make in your financial future. That's your Money Briefing for today.